conceptual framework, you just need to understand what's your asset, what's a liability. This, so it's a guide. And so in basic terms, Tim, though I'm borrowing it from the standard, in simple terms, what an asset is. So an asset from the definition in conceptual framework, in detail, is a present economic resource. So to put pane present economic resource, but they don't end there. Wobavati controlled by the entity as a result of a so an economic resource is a right which has got a potential to produce economic benefit. Also, simply put it, assets are what your company owns or controls that can bring future value. So that thing is going to bring future value in simple terms. Then there are three key aspects of an asset. So number one, to properly identify an asset, you need three essential aspects which must be present. Number one, you need the right. So can I check the right to the entity can produce, the entity can produce benefits, e.g. ownership. And the entity must have a right that can produce benefits. For example, ownership, contractual rights, intellectual property rights. Then there is two, the potential to produce economic benefit. So definition, can achieve the potential to produce economic benefit. We are simply saying the right must have potential to generate cash inflows. It can be cost saving, it can be an inflow, it can be a cost saving or increase the value. Then number three, control. We should have control. The entity must have the present ability to direct how the resource is used and obtain benefits from it. So all these three aspects must exist together for something to qualify as an asset under the conceptual framework. Team, then for simple example, an asset should give a company a right to benefit from something valuable. So those rights can take many forms. Like for example, it's the right to receive goods, right to receive cash, or right to receive a service, or right over the physical object, or intellectual property, like my patents, my trademarks. So these rights are usually established by contracts, laws, or ownership. So they are being established by contracts. Mchona chanobata IFRS 9 yataita taita financial asset. It can be laws, it can be ownership. So a simple scenario, this is simple, team. Don't worry, we're going to standard, but in general terms. A company purchases a delivery truck for business operation. The company, which means now is the legal right to use the truck, number one. It's going to decide how it operates, and it can benefit from its use in making deliveries to customers. So in simple terms, the truck is recognized as an asset because the ownership is going to grant it my rights to use it, derive economic benefit from its operations. Then the question, my rights are true, but my rights are, how are the rights established? So my rights from assets can be established through several means. So you need to understand how rights originate and also helps determine whether something qualifies as an asset for your business. So we've got formal sources, we have informal sources. My formal sources, one of my rights team. Think of contracts, signed agreements, granting specific rights, e.g. lease agreements, licensing deals. Think of laws, legal frameworks that protect ownership, e.g. my patents, my copyrights, my trademarks. Think of ownership, which is direct purchase or creation of a property which gives automatic rights. And the construct the tanker delivery vehicle, like in the previous question. Then they can come from what we call my informal sources. Informal sources, think about custom and practice. industry norms, or established business relationship can also create those enforceable rights. Key rule, part-timers, not all rights are assets. Kuti tizoti right yabuilder an asset, it should be a right ichaproducer ma-benefits beyond public access qualify. So if those rights can also produce ma-benefits beyond public access, example, think of a public road. It benefits everyone equally, so hapana asset. But a private access road, only you can use. Think about if you go to your local resorts and you not badara kuti upinde mukati. So in other words, in that circumstance, it becomes in what? In asset. Happy days. Happy days. Then the right aspects, if scenario deliver truck, a company buys a deliver truck for its operations. The company now has the legal right to use the truck for making deliveries, transporting goods, and conducting business activities. So here, because of those, the truck qualifies as an asset because it's going to give the company exclusive rights to use it for business operations and generate economic benefits. Make sense, the rating. Are you following? Hello? Manzwisi is a real right, the right part. Because ndo mchaona pauchazinda kwa AS2 yaungoti an asset is, because tikuti tatokudefinira ku conceptual framework. Ukaenda kwa AS38 yaungoti an asset is, avachatangidze kudefine an asset. An asset inenge yadefine ku conceptual framework. Parubatika team. Then let's proceed. Another key thing, let's go to the potential to produce economic benefit. So the right must have the potential to produce economic benefit. This includes, for example, cash inflows, cost savings, or increased value. Please, so it's not only inflows, it can be cost savings, it can be increased value. So the benefit doesn't need to be certain or immediate. It just needs to be possible. So in at least one circumstance, even if the probability of benefit is low, it can still qualify as in what? As an asset. So simplified, an asset must have the potential to help the company make money or save cost. So the key word here, team, is the potential. So actual realization, team, isn't required, but just the possibility. Team, the possibility, if there is the possibility and of future economic benefit in some scenario, a simple scenario, let's say a company owns a patent for a new product, but he hasn't started selling yet. Solution here, the patent is an asset because it has a potential to generate future sales revenue, even no cash has yet been received. So it's potential to produce economic benefit. Apana kungonzi producing economic benefit. Then twenda ku economic benefit potential. So an asset must have the potential to produce economic benefit. The current asset, the key insight is that the benefit doesn't need to be certain or immediate again. It just needs to be possible. At least one situation, even though probability benefits qualify here. For example, what's the key principle? Potential means possibility, not certainty. So if a right could produce benefits in any conceivable circumstance, it qualifies as an what? As an asset. The probability of benefits can be low, but what matters is that benefit is possible, not guaranteed. It's possible, please. It doesn't mean it should be guaranteed. So a simple scenario I've put there, it's A company owns a patent for an untested product, no sales yet, uncertain market demand. So the question, Ingavere, do we have the economic benefits potential? The patent is still an asset because in a potential to produce future revenue, even if success is what? Uncertain. Then we go to potential to produce economic benefit. Potential to produce economic benefit. What key? The key word upper team is potential again, not certainty. So an asset must have the ability to help the company make money or save money in the future. So do you have the potential to make money or save money in the future? So the benefit team doesn't need to be guaranteed or immediate. It simply needs to be possible. So in at least one circumstance. So even if the probability of receiving benefit is low, the resource can still qualify as an asset. What matters is the existence of the potential, not the likelihood of it happening, not the likelihood of it happening. Then, potential to produce economic benefit. A company owns a patent for a new product, but he hasn't started selling yet. The question is this patent an asset if no money has been made? The solution, the patent is an asset because it is the potential to generate future sales revenue. The benefit doesn't need to be certain or immediate. It just needs to be possible. So key insight, even low probability benefits qualify as an what? An asset. Then we have got control. We are summarizing. Are you following? Is it making sense? Then, thanks for that reaction. Control. Control means the entity has the present ability to direct the use of the economic resource and obtain the benefits from it. Do I have the present ability to direct the use of the economic resource and obtain benefits from it? So control usually comes from legal ownership rights, but can also arise from other means, such as keeping trade secrets confidential or having exclusive access. So key principle, if one party controls a resource, no other party can control it at the same time. So the entity must be able to decide how the resource is used and who is going to receive the economic benefits it generates. A simple scenario, a company leases a machine for 5 years with full operational control. So the question, is this an asset or not? The leased machine is an asset because the company directs the use and receives the benefits even without legal ownership. That's why I'm showing up for IFRS 16. We recognize a right of use asset because we have control. So what simply we should prove is the control aspect. Do we control the asset? Then another, how control is established. So control over an asset is typically established through legal rights, such as ownership, contracts, or licenses. However, control can arise from other means, like keeping trade secrets, confidential, or having an exclusive access to information. So let's start with the legal rights. So on the legal rights, control is often established through a legal ownership, contracts, or enforceable agreements. For example, a company purchases a building and holds the title deed. So this gives it a legal control over the property and its use. Then other means, control can exist without legal rights through trade secrets or exclusive knowledge. Just one moment, Tim. So, what's key? What's important? Other means, you have a trade secret, you have exclusive knowledge. So if, for example, a company develops a secret recipe and controls it by keeping it confidential. So the key rule here, if one part controls a resource, no other part can control it simultaneously. So no other part can control it simultaneously. Then the key element under control, or a simplified explanation, the company must control the asset, meaning it can decide how to use it. Yes, I hope Mom join up. It can decide how to use it, who benefits from it. So control equals to decision power plus benefits access. So if you can't direct how something is used or can't access its benefit, you don't truly have an asset. If you can't direct how something is used or can't access the benefits, you don't truly have an asset. So the key insight here, control usually comes from legal ownership, but it can also come from contracts, leases, or even keeping trade secrets confidential. So what matters? Who decides and who benefits? Who decides and who benefits? Another simple scenario, final scenario. So a contract, a company leases a machine for 5 years and can decide how to use it. The company directs how the machine is used and gets the benefit. So the leased machine here is an asset because it controls it. Why? We decide how to use it and who benefits from it. Are we okay with that? So in simple terms, I attender. I can see a hand.
Yes, trade secret. How does it become an asset? Trade secret.
So for trade secret, ndika developer secrets ndizvo. For example, think of Coca-Cola ndizvo. Coca-Cola vanoziva kuti toproducer sei their coke dzavo nefund ndizvo. I hope wakatomboona kwakauyiwo vana Pepsi, kukauyiwo vamwe vana chii, RC Cola nechii, but they failed to produce something chiri exactly or in the same manner mukupabata. So to put that formula, that is secret, it becomes an asset. That end in simple terms. So ukatotasa balance rana Coca-Cola, that patent iyoyo. Ndeyavanotengesera kuti Delta muda kuproducer mai tokutengeserai. So they will give you that. And then let's go to liabilities. Ndichazodzoka kumaparagraphs. But let's first deal with in simple terms. So a liability is a present obligation of an entity to transfer an economic resource as a result of a past event. In simple terms, liabilities represent what a company owes and must settle in the future. Unlike assets, which can bring benefits in, liabilities requires giving something valuable out. Is it making sense? So let's explore the 3 key aspects that defines what a company owes. So within the definition team, those zvinofanirwa kubuda ukanzi prove kuti iyi asset. Number one, a liability exists when three essential aspects are present. Number one, pane obligation. Number two, pane transfer of economic resource. Number three, it's from present obligation from past event. So kana chiti obligation, it's a duty the company cannot avoid, whether from contracts, whether from laws or business practice. Example, receiving goods from a supplier. It creates an unavoidable duty to pay. Then there is transfer of economic resource. So the potential to give up something valuable like cash, goods or services. So the transfer doesn't need to be certain. It should just be possible. Let it just be possible. Then we've got the present obligation from past event. The duty must exist now because something already happened. So example, selling a product with warrant creates an immediate repay obligation from that party sale. So understand. So let's start with the obligation. So in talking about an obligation is a duty or responsibility that the entity has no practical ability to avoid. So it can be legally enforceable through contracts or arise from custom and practice. So which is what we call constructive obligation. So there is legal, then there is constructive. So the obligation must be owed to another party, even if their identity is unknown. Simply put, a liability exists when a company must do something like pay money or deliver goods and cannot avoid it. So the key test is whether the company has any realistic way to escape the duty. If not, if we cannot escape the duty, it's an obligation. Hello? It becomes an obligation. So a simple scenario, yeah, a company receives goods from a supplier, but he hasn't paid yet. So then a paid amount is a liability, which is your accounts payable, because the company is in unavoidable duty to pay the supplier. If you've got any questions, please make sure you unmute. And let's go to types of obligations. Obligations can arise from different sources. So understanding these types helps identify when a liability exists. So the key is that the entity has no practical ability to avoid the duty, regardless of how it originated. As long as we can no longer avoid the duty, regardless of how it originated. So legal obligation, these arise from contracts, laws, regulations that are legally enforceable. So court can compel the entity to fulfill these duties. A company signs a loan agreement with a bank for 50,000. So the loan contract creates a legal, because takasainirana, the company must repay regardless of future circumstances. Let's go to constructive. This arises from custom, practice, or published policies that create valid expectations in others, even without legal enforcement. For example, a retailer always refunds dissatisfied customers within 30 days, though not legally required. So this one, since Vagaravachi exercise this established practice, it creates a constructive obligation. The customers now expect refunds based on that past behavior. So in simple terms, a liability exists when a company must do something like pay money or deliver goods and simply cannot avoid it. So think of it this way. If there is no escape from the duty, it's a liability. So the key test, can the company walk away? If the answer is no, then an obligation exists. There is no practical ability to avoid. Therefore, a liability is confirmed. That any question, please just unmute. Let's go to our question, just unmute. And this make sense. So mukatasa ma-standards ese pamunozoita AS40, AS16, AS2, AS38, IFRS 9, but not an asset or but not a financial liability. Arise from the conceptual framework. So do you understand the key parts of a liability? And it's a simple scenario. A company receives goods from a supplier, but he hasn't paid yet. The company obligation, the company must pay the supplier for the goods received. And so the unpaid amount is recorded as a liability. Why? Because the company is a duty it cannot avoid. That's an obligation. Then there is transfer of economic resource. A liability requires the potential to transfer an economic resource, meaning the company might have to give up something valuable like cash, be goods or services. So the transfer doesn't need to be certain. It just needs to be possible. In at least one circumstance, even low probability, obligations can qualify as what? Liabilities. So a simple scenario, a manufacturing company is being sued by a customer who claims a product caused injury. The lawsuit outcome is uncertain, but if the company loses, it may need to pay significant damages in cash to settle the claim. So the solution here, this is a potential payment is recognized as a liability because there is a possibility the company will need to transfer cash. So the uncertainty of outcome does not eliminate the liability. It only affects the measurement, not the existence. Existence is here, but the measurement, though in order to determine the uncertainty. Happy days. Then, so a liability exists when there is a potential to transfer economic resource. So the transfer doesn't need to be certain. It should be just possible in at least one circumstance. Even low probability obligations qualify as liabilities. So the obligation must have the potential to require giving up something, the key principle. It can be cash, goods, services. So certainty is not required, please. So if transfer is possible in any scenario, a liability exists regardless of the probability. A good example, a company guarantees a subsidiary's loan. Default seems unlikely at 10% probability. So this is a liability. Why? Transfer of funds is possible if in default occurs. Low probability doesn't eliminate the obligation. Low probability doesn't eliminate. Still on transfer of economic resources, a simplified explanation. A liability simply means the company might have to give up something valuable in the future. This could be cash, this can be goods, services, or other resources. The transfer doesn't need to be certain. It just needs to be possible in at least one situation. So the key point here, even if probability of payment is low, it can still qualify as a liability. What matters is potential for an outflow of economic resource. That's why muchizoona kuti IAS 37 tichazonosplita kune ma-provision, kune ma-contingent liability. Ndizvoka? Let's go to a simple scenario. A company is being sued by a former employee for wrongful termination and might have to pay damages. The company may need to pay compensation if it loses the case in court. And so the potential payment is recorded as a liability, though it was a contingent, because the obligation is potential to require transfer of an economic resource, even though the outcome is uncertain. But lastly, in a present obligation from past event, a liability must exist now because of something that already happened. Please, something that already happened. The company must already receive the benefits or taken actions. So, zvoreva kuti team togona kuti paitika iyo sekuti munhu ada kuti suwa haasati aenda kucourt. As long asati aenda kucourt hapasati pane a present obligation. So the company must have already received the benefit or taken actions that created the obligation. Future intentions or possible future actions don't create liability. Only past events do. Only past events do. So the key principle here, the obligation isn't created by what you plan to do tomorrow. It's created by what you already did yesterday. If no past event occurred, there is no present obligation and therefore no liability to recognize. Please, again, for example, a company sells a product with a 1-year warranty. Past event, the sale already happened, and they create a duty to repair defective product. So the warranty is a liability because the past sale is triggered the obligation to repair. Happy? All right. Then let's take it further. Another key important thing, still under past event. So a liability only exists when the obligation arises from something that has already happened. The company must have already received benefits or taken actions that created the duty. Future plans don't count. So present, please think about completed. Then if it's completed, then there is an obligation. So we are simply saying the obligation must exist now because of something that happened in the past. Future intentions or possible future actions do not create liability. So the company must already have received economic benefits or performed actions that triggered the duty. A simple scenario, a company sells laptops with a 2-year warranty. The moment the sale occurs, a past event has happened. So the warranty obligation is a liability because the sale already occurred and created the duty to repair the defective product. Happy days? Still on past events. Don't forget it's past events which create a present. So a liability only exists when something already happened to create it. The company must have already received the benefit, taken actions, or made commitments that now bind them to a future obligation. So the key point, past action equals which leads to a present obligation. If the duty only depends on future decisions or actions that haven't occurred yet, there is no liability today. So again, a company sells a product with a 1-year warranty, so the sale already happened. which create a duty to repair defects. So it's a liability. Past sale created the present obligation. Another scenario. A company sells electronics with 1 year warrant included. The moment the sale occurs, which means a duty is created to repair or replace any defective, and the warrant obligation is a liability because it results from a past event, which is the sale. The company already received payment and delivered, creating a present duty that cannot be avoided. So it's no longer avoidable. So in simple terms, Tim, what are we saying here? Assets, what the company owns or controls, that can bring future benefits. Liabilities, what the company owes and must settle in the future, e.g. loans, payable, warranties. So what are the key takeaways here? Assets are present economic resources with the 3 essential elements: rights that belong to the entity, potential to produce economic benefits, control by the entity. But if it's a liability, 3 key characteristics: duties that cannot be avoided, potential requirement to transfer resources, and the result from past events. So understanding these definitions forms the foundation of accurate financial reporting and decision making. So in simple terms, ndataura nelanguage yanzwisisika nemunhu wese, confirm. In simple language, ngatichizviisei mustandard, izvoka same thing ichocho icho takuchiisa kuconceptual framework. Questions before I get into the conceptual framework? Hello? Hello? So takuda kutanga tadhila nedefinition. What is an asset? So mukatarisa conceptual framework inonyatsotidefinira what an asset is. Ndizvoka up mukaenda pachitebho chiri pa 4.2 icho tiri kupiwa the definition what really an asset is. Ndizvoka what's an asset, a present economic controlled by as a result. But also put an economic right, a resource is a right in a potential to produce economic benefit. So chekutanga kuti ndichiprova team kuti zveshuwa ndine asset, ndakuya pane issue ye-right. Do I have the right to produce potential economic benefit? So mukatarisa pane the right, tikaenda papara 4.4 up. Economic resource is a right. Mukubabate team. So para mukachitarisa tinoda kuchiprova kuti chinombonzi a right chi. Ndakuudzai a right, it can be a right to receive cash. So tikachienda pa 4.6 to 4.13, please. 4.6 to 4.13. Vadongoburitsa kuti an asset is not just a physical thing, it is a right. Principle: a right can be the right to receive cash, right to receive goods or services, right to use an asset, even intellectual property rights. Treat as a team. So to my example, ndakupai. If, for example, come and purchase a machinery for 100,000, the asset is not the machine itself. If we purchase a machine for 100,000, asset, it's not the machine itself, but the right arising from ownership, which means which are the rights that arise from ownership. I can use the asset, the machine. I can sell the machine. I can pledge the machine. So the right arising from the ownership. Mukupabate retim kuti chiri kunyatsonzi right chi taku standard handizi tabvisana kugeneral taku standard mapabate here. You can show me through reactions. Rakumeka sense here standard team. I think I can see faith. There is a reaction. Others are some reaction. Ask Mukubatwe. Attender things that. So please, man, this is a recuncinonzi asset ichi. It's the right we benefit from the ownership of that asset. I can use the asset. I can sell the asset. That's why it is economic resource yatini. So nyasobata ipa definition up. Kuitira paya pamune makubuilda ma discussions enyu team ndo zviringotsvagwa naexaminer kuti unonyatsonzwisisa here kuti chinonzi right, it's not the asset itself, but my rights are rising from ownership. So the company is the right to use the machine. It can generate product using machine. Saka this, therefore, it also qualifies as an economic resource. So the economic resource pane the right. So here an asset exists because they need the right to use, the right to sell, the right to pledge. Then they need the potential to produce economic benefit. So that right is 4.6 team. Kusvika pa 4.13 paringobusa chinhu chinonzi right. Ndizvoka? Then 4.14 kusvika pa 4.18 yakudhila the potential to produce economic benefit. Kana tichiti chinhu chine potential to produce economic benefit, tikumboti chii in simple terms. So tikuti that right here, mabata, right to sell, right to use, right to pledge, that right, quite the machine, please. The right must have, the right must have the capacity to generate benefit, even if uncertain. So that's why patching the potential to produce economic benefit. So the right must have the capacity to generate benefits, even if uncertain. It can be cash inflows, it can be cost savings, it can be increased values. Those are the capacity to generate benefits. So please, an important thing, it does not need to be certain, but that it should only possible. It should be only possible. So a simple example of economic benefits. Let's say a company develops a new software, unsure whether it will succeed. To develop a new software, but we are unsure whether it will succeed. So the principle, a resource qualifies even if probability of benefits is low. So the software can generate revenue, can be sold. Therefore, it is the potential economic benefit, in a potential economic benefit. So even if it's not yet certain, it's still an asset. It's still an asset. Then we go to control. Control takubvira pa 4.19, that potential to produce. Then control takubvira pa 4.19. And kana tichiti tine control tikumboedza kuti chii. That's the most important thing. That's the critical thing. When can we say we have control? Control zvinombonya mukubabatere team. What control? So the key is what control. So ndikabata pa control team, chandinoda kuedza kuburitsa, an entity must control the resource, and it can restrict, so control and restrict others from accessing benefit. So please, control, it doesn't necessarily mean ownership always. Don't gonna kuvane control, but in this inner ownership. Mukubabatere team. For example, if a company leases equipment for 5 years, when can we say we have control? Think of your IFRS 16. If we can use the asset, if we can get benefits and prevent others from using the same asset, that's only control. So in this circumstance, lessee controls usage, he gains output from usage, others cannot use. So the moment if I control the usage, if I gain output from the usage and I can prevent others so that they cannot use, I can say an asset is there, there is the right of use. So I'm in simple terms, control doesn't necessarily mean ownership always. So whenever answering a question, is there an asset? State the definition, which is your para 4.3. Then break into right, economic benefit, ne control. Then make sure you apply to the scenario. State the definition. Then break into what the rights, economic benefits, ne control. Pana sare ritibatsirani. Pana sare ritibatsirani. You can show me through reactions if we are happy. So team, hondo yenyu pamunozoti 16 yakaoma, IFRS 16 yakaoma, wakatobvirwa kuvharwa kudefinition yekuti an asset. Pauri kuti IAS 40, IAS 2, kana uchinyasonzwisisa kuti what constitute an asset. So tawirirana team kuti chinonyatsonzi an asset chiyanditi the right to use. Chinonzi potential benefits chiyanditi control chi. Then let's go to liability. Liabilities. So liability that Hello. So don't go Vira. Network yangu ikutaka kubreaka. Liability tungoibvirawo futi ku 4.26. Handita kupinda mukuflag. Ndizo here. So what's a liability? Is a present obligation of the entity to transfer an economic resource as a result of past events. So if you go to our para 4.26, an obligation, which is our para 4.28, 4.28, we've got a present obligation. So mukatarisa 4.27, yakuitira for a liability to exist, 3 criteria must be satisfied. Obligation to transfer an economic resource, then the obligation is present, that exists as a result of a past event. So 4.28 yakuexplaina kuti chiko chinombonzi an obligation. Takuda kumita the obligation criteria. Let's meet the obligation criteria. So for obligation criteria team, a company guarantees, for example, it's a duty the entity cannot avoid. It can be either legal, it can be constructive. So legal, no contract. Constructive, it's a practice or it's based on a policy. This is a good example. Let's say a company guarantees products for 1 year. So part of obligation from the past practice, therefore the customer. So customer expects repair. Cannot avoid fixing. Taka liability via exists. We go to 4.36. 4.36 team. Yakutudza, let me scroll. 4.36. yakutuudza about the economic resource. So the second criterion for a liability is that the obligation is to transfer an economic resource. So despite this, again, what are the key things? The obligation must involve payment of cash or delivery of goods or services. So it's either payment of cash or delivery of goods or services. So a good example, let's say a loan of 50,000. So tiny obligation to transfer economic resource, which is your repayment of that cash. So the application, we must repay the principal. We must repay the interest. So here a liability exists. Then if we go to 4.42 to 4.47, Yakutu, that the last part, the present obligation, don't forget, as a result of past events. So there is a present obligation as a result of past event. So the third criterion is team. Liability arises from something already done in simple terms. Think of, for example, let's say an employee worked in December, but the employee is going to be paid in January. So the principal team services were already received. So an obligation exists. The company must now pay the salary. So we can create an accrued expense, which is a liability. So always in exam team, identify the obligation, confirm transfer required, then link it to past event. So bring out the three things: identify the obligation, confirm transfer required, then link to a past event. Ndapedza nemi. Yepi? Hello. Tabata conceptual framework now, and that's all about the conceptual framework. All right. Good night. Tochisangana mu next session. Rukondinya ne relevant costing. Rukondinya ne relevant costing today.